Finding the next Amazon stock isn't just hard, it's getting harder. And that's why in this video, I'm going to show you a simple trick that you can use to almost eliminate your chances of losing money in the stock market. This is a time-tested technique that most investors understand. And no, I'm not talking about using stop losses or other fancy trading tricks. Take a look. The stock market is the most accessible wealth building tool that we have because you can take your extra $10 or your extra $100 and buy some Amazon. But now you're not buying access to Amazon Prime, you're buying access to Amazon's profits. But there's two problems with this. The first problem is if you pick the wrong company, you lose everything. I mean, we all remember Sears and Bed Bath & Beyond, and most recently, Spirit Airlines. The second problem is that finding the next Amazon stock is getting harder. In the mid-1960s, a company that made it into the S&P 500 would stay there for approximately 33 years. The S&P 500 is a list of the 500 largest companies in the stock market. Today, once the company makes it into the S&P 500, the average tenure for that company is just 15 years. Why? Because technology is making it easier for companies to grow and also fail faster. This makes it more difficult for you to pick the right company to invest in for the long term. But it doesn't make it more difficult for you to make money in the stock market. In fact, it actually makes it easier. This is a chart showing the stock market for the last 100 years. The gray bars indicate the recession. And when we zoom in, you can see how crazy the stock market is, where it goes up and down and up and down. But when you zoom out, you can see that over the long term, the stock market generally goes up. But despite the fact that the stock market goes up over the long term, most people are losing money in the stock market. And the reason why so many people are losing money in the stock market is because they're trying to find the next Amazon without understanding how to research a company, without understanding how to do the analysis of a company, without even understanding what it is that they're investing in, so they get caught up in the emotions. When in reality, the game that most people, not everybody, but most people should be playing, that way you can just win in the game of the stock market, is by playing a game called DCA, dollar cost averaging. Now I gotta give you the disclaimer, okay? I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But what dollar cost averaging means is you're gonna just keep investing your money into the market when markets are up, you keep investing when markets are down, and you keep investing when markets are sideways. That way, over the long term, as markets go up, you win. Let me give you a visual depiction of how this works, and then I'm going to give you specific examples of funds that you can consider investing in. That way you can actually do this DCA. So this is a very rough depiction of the stock market. We know that the markets go up and down. We've seen these recessions, we've seen these market crashes, we've seen these downturns in the markets. But despite that, we have seen the market go up over the long term, but it hasn't been a straight line. It has been up and down and up and down. The way that dollar cost averaging works is you just keep buying. So you start buying here, you buy 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 here. That way you're averaging your way into the markets, and over the long term what you see is you just keep buying, but over the long term now you get to take advantage of markets generally going up over the long term. The reason why so many people fail at this is because when these downturns happen, people panic and they sell. You know, we talk about buy low, sell high. The reason why so many people lose is because they buy high and sell low. Because when markets go up, people feel like markets will keep going up. When markets go down, people think that nothing will ever happen good again. When in reality, we've seen recessions. We've seen about 16 recessions over the last 100 years. They happen. They're going to continue happening. But the way that you win in this DCA game is you just buy when markets are up, you buy when markets are down, you buy when markets are sideways. You just keep buying regularly. And let me actually show you some things that you may want to consider investing in. Now again, I'm not telling you what to invest in. These are just some examples. And if you are an investor and you want to stay up to date on what's happening in the financial markets, quick reminder that my team at Briefs Media publishes a free financial newsletter 6 times a week called Market Briefs, where we break down what's happening in things like the stock market, the economy, the housing market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and it's completely free. So if you have not joined Market Briefs yet, well, it's completely free and we would love for you to join. And all you gotta do is click the link down in the description below to join. VTI is an ETF that you can buy that gives you exposure to the total stock market. An ETF is a fund. You can think of it like a basket of companies, a group of companies. And so now instead of trying to find the perfect company to invest in, you can just invest in this fund. So if you go onto your stock brokerage app and you put in this ticker symbol, well, this is going to give you exposure to the total stock market. It's created by an institution called Vanguard. And so now when you buy VTI, you are essentially buying the total stock market. When the stock market in sum goes up, this fund generally goes up. When the stock market in sum goes down, this fund generally goes down. The second fund that you may want to consider is called SPY. This is created by an institution called Spider, and this gives you exposure to the S&P 500. I talked about that a little bit earlier in this video. The S&P 500 is not every company in the stock market, but it's a group of the 500 largest companies in the stock market. So if one of the companies goes bankrupt or becomes smaller, then this fund will automatically kick that company out and replace it with a different company that now enters the S&P 500. So again, when you buy this, you buy one fund and you get exposure to the 500 largest companies in the stock market. Option number 3 is a fund called QQQ. This is an ETF that gives you exposure to the NASDAQ. You might have heard of the term NASDAQ before. The NASDAQ is a group of the 100 largest non-financial companies. So many companies in this fund in the NASDAQ are tech companies, because if we take a look at some of the largest non-financial companies, many of them are tech companies. So many people look at this fund as a way to get exposure to the tech industry, but the NASDAQ is a basket of the 100 largest non-financial companies. Maybe you're like me and you really like cash flow. Well, some companies in the stock market pay dividends. A dividend is a cash payment that a company gives you generally every quarter. They deposit this directly into your brokerage, and this is called a dividend. Well, you can invest in funds that specialize in dividends. For example, VYM, this is an ETF that I invest in. As a disclaimer, this is created again by Vanguard, and this is investing in high dividend paying companies. So now, if you're interested in producing cash flow instead of finding the perfect dividend paying company, you could also consider investing in a fund that gives you those dividends. So VYM is one potential option. Another potential popular dividend play is NOBL, Noble. This is an ETF that gives the exposure to dividend-paying companies in the S&P 500. So we have the S&P 500, which is a group of the 500 largest companies in the stock market. This doesn't invest in all 500 companies. This only invests in the dividend-paying companies in the S&P 500. But it actually gets a little bit more specific, because this is only investing in the dividend aristocrats in the S&P 500. Meaning, number one, you have to be in the S&P 500. You have to be one of the 500 largest companies in the stock market. And then number two, you have to be a dividend-paying company. And then number three, you have to have increased that dividend every year for the last 25 years minimum. So this is investing in companies that have been consistently increasing their dividends that are also a part of the S&P 500. So if you're interested in cash flow, these are a couple of things that you can consider. If you want broad baskets of the stock market, here are a few options that you can consider. Now again, this is just the beginning of your research, but the next question you're going to have is, well, Jaspreet, how do I actually make it happen? How do I actually invest? And how do I actually see the returns that I'm hoping for? Well, let me show you. I'm going to give you a couple more acronyms that I created, but the name of the game that we're talking about is DCA, dollar cost averaging. I like to call this passive investing. And the way that you win here is you want to have a CPA strategy, consistent, passive, and automatic strategy where you're automatically investing this money. So let's assume now this is your checkings account, and you have money that's deposited into your checkings account every week, every 2 weeks, or every month, whatever it might be. As you get paid, you want to CPA, consistently, passively, and automatically have some of your money invested into your portfolio of funds. So maybe you have 4 funds that you want to invest in, maybe you have 2 funds that you want to invest in, but now every week, every 2 weeks, every month, you pick your own cadence. You want this to automatically be invested into your portfolio of funds. So let's just assume you have 4 different funds. This is your pie. So you have fund 1, fund 2, fund 3, fund 4, and just for simplicity, I'm going to assume that you have 25% of your money going into each one. So if every month you're going to invest, say, $100, well then $25 will go here, $25 will go here, $25 will go here, and $25 would go here. Now you can divide this up however you want, but now you get this idea that every time you get paid, some of your money is going to be invested. Because remember what I told you a little bit earlier in this video, markets go up, markets go down. We have seen 16 recessions in the last 100 years. We're going to see more recessions. We're going to see more market crashes. It is going to happen. And what's going to happen the next time the market crash happens, some of you are going to say, Jaspreet, the markets are crashing. What do I do? It doesn't change what you do. If you're following this strategy, all you do is keep following the same strategy. In fact, the only change you might want to make is invest a little bit more aggressively. The mistake that so many people make when markets go down, and remember me when I'm telling you this, because we will see markets go down at some point. I don't know when the next market crashes. I don't know when the next recession is going to be, but we know it's going to happen. And what else is going to happen is people are going to freak out when it happens. But I want you to remember this video. When people freak out, that's the time to keep buying. Because when people are losing their minds, those create the best buying opportunities. And it's very hard to be sane during those times, because I've seen it now a couple times. Like I went through the 2008 crash and I was able to find some great investment opportunities after the 2008 crash. I went through the 2020 crash and I was able to find some great investment opportunities during that time. And I was actually on YouTube during the 2020 pandemic. This 2020 economic crisis isn't done yet. But if you don't come out of this crisis a little bit smarter so you can take care of your money better, you wasted this crisis. So I saw how people really lose their sense of kind of calmness and smart investing strategy because people think the whole world is going to constantly end anytime you see something bad happen. But again, those create the best opportunities. So what do? You just keep CPAing, consistently, passively, automatically buying no matter what. In fact, the only change you might make is you might want to buy a little bit more aggressively. And this is where now, again, what I like to do is make it automatic. There are some brokerages out there that are very good at this to help you specifically with this. You can find whatever is right for you. If you're looking for a potential recommendation, I use a company called M1. They are an advertiser for us. They have been a sponsor from Minority Mindset. If you use my link down in the description, I will be compensated by M1. But the reason why I like M1 specifically is because this is exactly what they specialize in. They specialize in this type of passive investing and this type of dollar cost averaging investing, where you can pick your pie of funds, however many funds that you want, and then you can set your cadence, whether again it's every week, every 2 weeks, or every 4 weeks. You just set your cadence, then you set however much money you want to invest, whether it's $10 a month, $100 a month, or $10,000 a month, it doesn't matter. You set your cadence, and now you can choose how much of your money that you want to be going into each fund, into each slice of your pie. So once you set it, now you can forget it, because now this will happen automatically. That's why I like the system, but again, you can find the one that you like for you. But if you want to learn more about M1, I have their link down in the description as well. But the whole game now is consistently, passively, automatically buying. Now you might be saying, well, Jaspreet, what's ABB? ABB is always be buying. And I have to emphasize this because people forget that things will go wrong. And I've said this multiple times, and the reason why I'm saying that is because things will go wrong. I don't know if it's going to happen next year, 5 years from now, 10 years from now, but eventually something bad will happen. But those are the times, especially if you're investing in broad funds. If you're talking more about the niche stuff, that's a little bit different. But everything that I've been focusing on today is the broad basket funds. We have seen market crashes, we have seen recessions. During those recessions, markets go down. We might see down periods for months, even years. But those are the times to always be buying, because then when things start to go up, you want to make sure that you can realize those gains as well. The mistake that so many people make is they start buying when things are going up. And then when things start to go down, they stop buying, or that's when they're selling, because that's when they start panicking. But the way that you win as a long-term investor who's playing the DCA game is you just keep buying. And what we have seen is over the last 100 years, the stock market, more specifically the S&P 500, has grown by more than 10% a year on average. That doesn't mean the markets always go up. Remember, we've seen 16 recessions over the last 100 years. But despite those 16 recessions, we have seen the stock market rise by more than 10% a year on average. That means despite the market crashes, despite the booms, we have averaged over 10% a year in growth. Does that mean we're going to see the same returns for the next 100 years? No. Past returns don't guarantee future returns. Investing is risky, but we have seen this time-tested over the last decades and century that this has been proven to build wealth. And so now, how do you do this? Well, you can find the right brokerage. You can figure out how much money you can invest. Try to increase it over time as you make more money. Try to increase it when you see good buying opportunities, meaning when markets are down. Then you just keep holding and let the markets do the thing. And if you're investing for dividends, keep reinvesting those dividends as well until you have enough dividend cash flow to actually add some sustainable income to your life. Once now you have enough cash flow to live off of or to add some sustainable income to your life, well, now you can start using the cash flow to supplement your lifestyle or to fund your lifestyle. But it starts with this. And the reason why it's so difficult is because it takes time. The first few years, if you're doing this, you're going to see almost nothing. You're going to see almost no returns because market's going to go up and down. You're going to be very emotional. But remember, don't touch it. ABB, CPA. Keep it consistent, keep it passive, keep it automatic, and always be buying. First few years, you're not going to see much. Year 3, year 4, year 5, now you start to see a little bit more returns. You start to see a little bit more money in there. Now it starts to be a little bit more exciting. It can also be a little bit more scary when markets go down, but remember, ABB. Year 6, year 7, year 8, now you start to see more returns. You start to see the bigger gains. Year 9, year 10, now you're going to be really surprised at how much this wealth has really grown. Maybe now you start to go through that downturn and it can be scary, but hold through it. And that's when you really start to see the larger gains because now you have built this machine that now has this asset that's working to grow for you. But in order for you to get there, you have to continue funding it for that period. That's how you win in this game. And that's how you can eliminate or virtually eliminate your chances of losing. Of course, investing has risks. You can't mitigate every risk. I mean, there's always possibilities for anything. However, if you're investing for the long term, the longer you invest, the lower your chances are for losing money. Let's assume that you make $5,000 a month. After taxes, you will be left around $3,833 a month. Now, when you get this $3,833 a month, you pay your rent, you pay your mortgage, you pay your groceries, you pay for some nice stuff here and there, and then you have no money to save and invest. So this is what we're gonna do differently.